subscribe.
Good morning, ladies and gentlemen. Welcome back to the channel. My name is Dave Natch. I speak stocks. Today is Boxing Day, Tuesday, December 26th. Hope everybody came back well from the holidays. Now it's back to business. In today's video, I have one play for you. But before I go into the play, let me delve into Friday's recap of the overall markets. The markets ended mixed. The Dow closed down 0.04%, settling at 37,386 the Dow. The Nasdaq begging to differ. They closed up 0.19% on Friday to settle at 14,993 the Nas. Apple closed down 0.5% to settle at 193.60 Apple. Let's delve right into it. Dave's play today is a SP play. In and out, grab and go, one and move. Do not overstay your welcome. ARBB. ARBB is up 104%, trading at $1.94 at the recording of this video. The higher day thus far in the pre-markets, $2.11. If this one retracts below $1.71, this might be a no-go today. There's no news out, but we just ride in price action. ARBB has spikeability. For example, on April 21st, the stock went from 368 to 540 on a volume of 1.4 million shares exchanged hands. This one is in the IT space and their headquarters out of Malaysia. Let's get the tires.
What's the tires on this?
Brother, you didn't kick them.
Oh, I'd rather I check them out before I'm going to think about purchasing.
They were a market cap of 25 million. They have a low float of 1 million. 95% of the float are held by insiders. 0.01% of the float are held by institution. And shorts has a measly 0.07% of the float. Their profit margin is a positive 11%. Their operating margin is a positive 17%. Their ROA, return on asset, is a positive 4%. ROE, return on equity, is a positive 9%. 242 million in revenues. Revenue per share 11.01. This is ARBB. Their EBITDA, earnings before interest, taxes, depreciation and amortization, is 40 million. A net income of 26 million. Total cash of 61 million. A total debt of a low 203k. Current ratio is sitting at a healthy 2.86. Their operating cash flow is a positive 54 million. Their leverage free cash flow is a positive 17 million. ARBB. That's all I have for you, ladies and gentlemen. Don't forget to follow me on X at WT for my stock alerts. In the meantime, in between time, always protect your neck. Always do your research. Please do not invest more than you're willing to lose. Whenever you see some profits, take some profits, because now you see them, now you don't. Dave Natch, I'm out. Boom, bam. Make your next trade your best trade. Please trade responsibly, and I'll see you when I see you. I'm out.
Do remember, if you wish to open a trading account, check out my Webull link below. You will get some free stocks. Minimum deposit required is just 1 penny. Also, pre-market hours trading starts at 4 a.m. sharp. 4 a.m. sharp with Webull. Webull only, the way to go. Pre-market hours trading is very risky. It's not for the risk averse. Thank you for watching. Dave Natch, I'm out.
8. Although it doesn't happen very often, I really like my trades to be perfect. When I make a perfect call, it feels so good that it makes up for all the times that I don't. Agree or disagree? 29. Do you ever find yourself planning trades you never execute? and executing trades you never planned? Yes or no? 30. In a few sentences, explain why most traders either don't make money or aren't able to keep what they make. Set aside your answers as you listen through this audiobook. After you've finished the last chapter, Thinking Like a Trader, take the attitude survey again. It's at the back of the audiobook as well. You may be surprised to see how much your answers differ from the first time. Chapter 1. The Road to Success. Fundamental, technical, or mental analysis. In the beginning, fundamental analysis. Who remembers when fundamental analysis was considered the only real or proper way to make trading decisions? I started trading in 1978. Technical analysis was used by only a handful of traders who were considered by the rest of the market community to be, at the very least, crazy. As difficult as it is to believe now, it wasn't very long ago when Wall Street and most of the major funds and financial institutions thought that technical analysis was some form of mystical hocus pocus. Now, of course, just the opposite is true. Almost all experienced traders use some form of technical analysis to help them formulate their trading strategies. Except for some small, isolated pockets in the academic community, the purely fundamental analyst is virtually extinct. What caused this dramatic shift in perspective? I'm sure it's no surprise to anyone that the answer to this question is very simple. Money. The problem with making trading decisions from a strictly fundamental perspective is the inherent difficulty of making money consistently using this approach. For those of you who may not be familiar with fundamental analysis, let me explain. Fundamental analysis attempts to take into consideration all the variables that could affect the relative balance or imbalance between the supply of and the possible demand for any particular stock, commodity, or financial instrument. Using primarily mathematical models that weigh the significance of a variety of factors, interest rates, balance sheets, weather patterns, and numerous others, the analyst projects what the price should be at some point in the future. The problem with these models is that they very rarely, if ever, factor in other traders as variables. People, expressing their beliefs and expectations about the future, make prices move, not models. The fact that a model makes a logical and reasonable projection based on all the relevant variables is not of much value if the traders who are responsible for most of the trading volume are not aware of the model or don't believe in it. As a matter of fact, many traders, especially those on the floors of the futures exchanges who have the ability to move prices very dramatically in one direction or the other, usually don't have the slightest concept of the fundamental supply and demand factors that are supposed to affect prices. Furthermore, at any given moment, much of their trading activity is prompted by a response to emotional factors that are completely outside the parameters of the fundamental model. In other words, the people who trade, and consequently move prices, don't always act in a rational manner. Ultimately, the fundamental analyst could find that a prediction about where prices should be at some point in the future is correct. But in the meantime, price movement could be so volatile that it would be very difficult, if not impossible, to stay in a trade in order to realize the objective. The shift to technical analysis. Technical analysis has been around for as long as there have been organized markets in the form of exchanges.